You've been with BC Partners since 1992, so you've seen a few peaks and valleys in private equity.
That's correct.
How would you describe the state of the industry today?
Well, the industry is obviously much more developed today than it was in 1992. The industry is competitive, the industry is mature, and valuations are high. On the other hand, I think all of the market participants are still continuing to find opportunities to invest in.
Well, let's talk about the valuations and everything else. Prices are rich.
Yeah.
There's behavior like EBITDA givebacks, the absence of covenants or seeming absence of covenants in many financings. There's the sheer amount of capital available. Mm-hmm. What do you make of those and other signs of what people might call froth?
First of all, what people might call froth, I think is very often misunderstood. As far as valuations are concerned, they are high, and that's driven by the public markets. Leverage is high, but very, very differently and much lower, actually, than in 2007, 2008. And the big difference is that interest rates are much lower. So the cushion that you have from a cash flow standpoint for any companies that you buy, has nothing to do with what happened like 12 years ago. In terms of the amount of money available, which you just referred to, what's really important to understand is that you have to compare that to the average number of years that it takes to invest it. And currently, it's still between 2.5 and 3 years, which is an equilibrium. So there's not as much froth as people, necessarily can imagine from the outside.
But tell me this.
Yeah.
Private equity is supposed to be the disciplined buyer. How do you get comfortable paying 12 times EBITDA for a business?
You need to pick your spots. As far as I'm concerned, I think the industry is disciplined. It's difficult to do, obviously. But you can, if you have the right setup internally, if you have the right mindset, the right DNA, you can continue to be disciplined. Now, paying 12 times EBITDA requires you to know exactly how you're going to add value, how you're going to develop the business, and have a clear strategy from going from A to B.
But as a matter of principle, you don't have a problem with it?
Well, I'd rather pay 5 times EBITDA, like everybody else. It's not a question of having a problem or not. It's a question of does it make sense and does it work? And you have a balanced risk reward. You can still find opportunities in today's world with a balanced risk reward. It is harder than it was like 20 years ago, but it's still possible.
Tell me something. Are you seeking to make capital flexibility a bigger part of your financing arrangements, the way that KKR has done, the way that Blackstone has done, the way that Carlyle has done?
By capital flexibility...
Excuse me, collateral flexibility.
Collateral flexibility. Look, you referred to a few seconds ago about covenants and, looser terms in debt agreements. You may have seen that, but a few years ago, I think it was a Moody's study just after the financial crisis that sort of analyzed all of this across the industry. And they found that actually having looser covenants is better because it allows you to buy more time to deal with the problems that you have to the extent you have a problem and avoid bankruptcy. So, actually looser covenants, which I know is a bit paradoxical, is actually a good thing for everyone. But it takes the power away
from your creditors.
It takes the power away
and some of your creditors are already unhappy about what's going on with PetSmart.
The litigation was settled, 2 weeks ago, so they're much happier now. Look, it's a balance, right? The creditors, at the end of the day, they don't want to take control over from you. Of the company because, they just want to be repaid. And looser covenants, at least in my opinion, across the industry, it enables you to deal with the problems, as long as you continue to pay your interest expense, to reimburse the debt that you need to reimburse, and to work it out for the long term. It is better for everyone, including creditors.
BC Partners manages some $27 billion, most of it in private equity. You've entered real estate, you've entered credit.
Yeah.
You're still a fraction of the size of a Blackstone. Where does BC Partners go from here?
Well, we have a mature PE business, which has been operating for 33 years with the same strategy, initially just in Europe and now across the Atlantic and in North America. We've been operating in North America for 11 years. We still have some room to grow and mature. We've launched credit, which is a very, very deep asset class. 2 years ago, we managed $2 billion in credit. We're launching real estate a year ago. We're raising our first fund at the moment. Clearly, those are asset classes which are very synergistic with what we do in private equity, which we can scale. And in private equity, it's all about continuing to do your best, continuing to deliver good returns for your investors. And, we'll continue to drive the firm and build the firm from there.